Troy Kearns bringing it to you from our Las Vegas studio. In today's video, we're going to be going over the types of mortgages that you can apply for, what they are, how you can benefit from them, whether they're the first-time home buyer loan, whether it's an investment loan, whether it's an FHA loan, all the loan types. We've got an expert in our studio today, Mr. William Zeigler. I've known him for about 12 years. We've done lots of transactions together. He is the expert. We always bring an expert in. So in this next video, we're gonna go over exactly what you need to do in order to qualify for any type of loan, different interest rates and how they apply. Make sure you stay tuned till the very end, because at the end, we're gonna get into the beefy stuff. So why should you want to watch this video? If you're going to invest in real estate, you need to understand financing. If you're just relying on cash, you're not going to get very far. If you are allowed to leverage your money and buy more properties, you need to have a good mortgage broker. You need to have a good lender. You need to have a good banking relationship. That's why you should care about this video. William, welcome to the show.
Always good to see you.
Good to see you. So I know this is like easy for you. Break down what a conventional loan is.
Conventional is any loan not backed by the U.S. government.
Okay.
First mortgage, second mortgage, third mortgage, any bank loan that's not backed by a federal institution.
What about when they say like Fannie Mae direct underwriting, and that's a conventional?
Fannie Mae is not a government-owned company. It's actually a stockhold company. And that loan is being sold to Fannie Mae. They're not the ones actually funding the loan. So they underwrite directly to Fannie Mae guidelines, which is every conventional loan is underwritten to Fannie Mae, Freddie Mac's guidelines.
And on a conventional loan, how much money you got to put down?
A bunch of new programs out. You can put as little as 3% down with Home Ready, Home Possible, and Home One requires 5% down. Those are the easy get-in. Down payment assistance allowed on those products for first-time buyer. Normal conventional buyer puts down 5%, and depending on FICO score, you can actually get in with 3% down.
And what kind of interest rate am I going to pay in today's market?
On the Home Ready and Home Possible, they have less adjustments for FICO and loan to value, so those rates are going to be in the high 2s to low 3s.
High 2s to low 3s. Great. And if I'm going to get a loan on an investment property, what type of loan do I need?
So if you go, again, underwritten to Freddie Mac's guidelines, you can go 15% down. Mm-hmm. If you go on 1 to 2 unit properties, 3 to 4 unit, 25% down. Fannie Mae is going to require 20% down, and they're going to require 25% down on multifamily.
Got it. Okay, so that's good. So if I'm going to do an investment property, I'm going to more than likely get a conventional loan.
90% of the time.
Unless it's like an
HUD repo. You can do a HUD repo or VA repo. Investors can buy those.
What are the benefits of getting a conventional loan versus other loans?
Depending on FICO score and loan to value, conventional loans are cheaper than other loans, and the mortgage insurance reduces down by the loan to value. So for example, somebody with a 640 credit score putting down 40% gets a cheaper rate than someone with a 780 credit score putting down 5%. It's all about what they call risk-based pricing. The lower the risk to the investor, the lender, the better the rate.
So we did a video on this guy who was saying that you need like a 740 or 760 to really get a rate break, or 780 even. And I was like, that doesn't even apply after 720 really.
So it does, but it doesn't. So if you're at a 720 FICO score and you want to try to get the best possible rate, then the best option, it's going to cost you between 1/8 and 1/4. That's the adjustment on the loan to get the same rate as somebody with 740, 780 credit score.
But could you buy it down?
Yes, I'm saying it would be a 1/4% buy down to get the same rate that somebody else would get.
Right. So it's just a cost analysis of the investment.
It is. So from 720 to 740, it's a 1/4 higher than somebody with a 780 score. From 740 to 780, it's an 1/8 difference. So you can buy that out. It's actually a fee to the back end of the loan.
It's called a discount point, right?
It's a discount point, but you can actually buy, there's a fee called loan level price adjustments on a conventional loan that are based on FICO. Right. So discount point, buy it out the same way, 6 to 1, half a dozen the other, but literally you're just basically paying for having the lower FICO.
Right. So my point in this was, he said, don't even get started investing unless you have a 720, 740. I'm like,
our average investor has a 660 because, again, you're going to be putting down X number X number of dollars or percentage on the loan. FICO score at that point, again, the risk goes down to the bank at 20%, 25%. The adjustments are much less than a higher loan to value. So not really true.
And investors generally are going to have a lower credit score because of them pulling their credit, them trying to leverage it, all those things, right?
Yeah, so we have investors all the way down to 640, but they have good cash flow and rate of return. And most lenders can package stuff for an investor so they have multiple loans where it's easier for them. Fannie Mae now allows you to go up to 20 loans. So you can kind of just keep repeating that same investor and keep putting them into better stuff and refinancing it, pull their cash and put them in new things. I would say our average FICO score is 660 to 680 on those loans.
Right, and I would probably fall in that category. My stuff is always taking a hit. Trying to keep your credit score up is very difficult.
Yeah, and people don't realize that a lot of it has to do with the loan to value of their available credit to use credit, more so than payment history.
Right.
I have a lot of people go to me and say, oh, I've paid all my payments on time. I understand my scores are low. Well, you've got $30,000 of available revolving debt and 26 of it used. If that 26 is down to 18,000, all of a sudden your score will be 740.
Let's break down what a 30-year loan is and what a 15-year loan is conventional or any other loan, and why you would recommend somebody get something and what your personal recommendations are for those types of loan. How do you qualify? What are the requirements, those types of things?
So on a conventional loan, you can go for 30-year, 25-year, 20-year, 15-year, 10-year, and 5-year.
Okay.
So
you can have 5 years?
You can have a 5-year now. It really depends on the person's goals and what they're trying to accomplish.
Right.
For example, somebody comes to me and they're 40 years old, they've got every credit cards maxed out, they don't have a lot of savings ability. We try to put them in a 15-year loan so they'll have something at retirement.
Right.
Okay. You have somebody that has very little debt that's got huge saving ability. They're going to be able to take their money, put it in a retirement account at 7%. We try to put them into a 5% down 30-year loan, so their money's going to grow as the property's growing and the loan's going down.
So it just depends on the situation.
Depends on the client.
Yeah.
And so qualification is going to be the same across the board. Debt to income ratios, max 45 on most investors, as long as you get an automated approval. I have a client that's pretty well known in town here in Vegas, and he's upset that his loan, he had to pay off a bunch of debt, but he took $200,000 in income. He took a $90,000 loss, and then, he wanted to have a $1.2 million loan. With his car payments, he didn't qualify.
Right.
So he had to pay off debt to actually qualify.
Which is why we tell people, don't buy debt, use depreciation to bring down your tax liability. Depreciation is basically accelerating a paper loss on your property.
Well, it's really important that you take the depreciation on your vehicles, on your property. And the other part of it is make sure that if you're taking them as business expenses, that all the expenses on your credit report are being written off through the business, because then those debts don't have to hit you in your debt ratio.
Got it. Can you talk a little bit about adjustable rate mortgages? I don't even hear that term too much anymore.
Because they're more expensive than fixed rate mortgage right now, first time ever. So 10-year interest only ARM or 10-year ARM is probably a half a point higher than a 30-year fixed. Now, in overall, adjustable rate mortgages are right for the right person. Again, going back to the scenario for the person. You have a young couple that's going to move into a property, depending on having 2 kids, they're going to move in the next 10 years. Putting them on a 10-year ARM, where they're going to get a cheaper payment, normally, not in today's market, but normally they would get about a point cheaper. That 10 years is fixed.
Right.
So they have 10 years to do anything with that loan. It's a regular 30-year fixed, but the first 10 years is fixed. After that, it becomes a 10-1 or a 10-6, which means the interest rate can adjust up or down 1% every 6 months or every year. That's the 6 or the 1.
Great. So that brings me to another point, which I want to, it's very confusing for a lot of people. Can you break down what an amortization schedule is and how it applies to a loan?
Yeah, so amortization basically in Latin means to put to death slowly. So
What, in Latin?
In Latin, it means to put to death slowly.
Oh, that's good.
So literally, you're paying almost all your interest up front, and towards the first 12 months of the year, about 80% of that money is all interest. On your 30th year, it's about 80% principal. So as you start, a schedule is going to tell you exactly every year, which you'll have in your loan documents. Every lender is required to give it to you, telling you exactly what you owe each year if you stay on that loan.
Is that they call it TILA, Truth in Lending?
No, that's just an amortization schedule.
Got it, got it. So just basically, you're going to understand, if you're not paying principal on those first years, you're just paying interest. So add a little bit more money to principal. What's a good rule of thumb to get that debt paid down if you can?
If you do 2 extra payments a year, it cuts it down to about 16.2 years.
And should you apply that directly to principal?
You need to write a separate check that says principal reduction payment to the lender.
Got it. Just so it's appropriated the correct way. Okay, great. So let's talk about an FHA mortgage. What's that? Who qualifies for that? How is that used?
FHA was a loan that was a lot more popular in the past. Now with the Fannie Mae products I talked about, the 3% down, it's actually cheaper and the mortgage insurance is cheaper than FHA. However, FHA's got a bunch of good benefits, especially for immigrants that have come in the first generation immigrants, for people that use a lot of cash, for people that are first time buyers with not a lot of credit history and some of the negative credit history. For example, FHA, you can go 2 years after a bankruptcy, 3 years after a foreclosure. Conventional, again, after a bankruptcy is 4 years, a foreclosure is 7 years. So with FHA, you can even get a loan while you're in bankruptcy in a Chapter 13. So FHA is designed to get people into homes. The mortgage insurance on that never goes away, unlike a conventional loan. But the rate's cheaper than a conventional loan, but the blended rate's about the same. And it goes down to a 580 credit score, where you have to have a minimum of a 680 credit score, or sorry, 620 credit score to go conventional.
Good information there. Okay, so let's jump right into the next thing, which is a VA loan. Can you explain that?
Yep, VA loan is a loan that you earn becoming a veteran. You have to have 6 years if you are National Guard, 6 years of service and a letter from your CO, and you can get your security eligibility. Or if you've been active duty and honorably discharged, then you have automatic eligibility. Or if you're active duty currently, you can get a VA loan, only for veterans. It's a zero down payment loan. Everybody always says $1 down VA, but it's truly a zero down loan. And there is no monthly mortgage insurance. It has upfront what they call VA funding fee. First time use is 1.35%. And that again has a lot easier guidelines than a conventional loan. So the conventional loan you're gonna have is gonna give you a debt ratio of a max of 45. With VA, they use residual, and you can go to a 60-70% debt to income ratio as long as you have the residual income calculation.
So basically what he's saying is you can spend the most amount of money with a VA loan, because you're talking like very technical. So basically you can, it's a lower debt to income ratio, so you can stretch your money further.
It's not that, it's basically they use a residual income calculator, which helps the veteran. As long as you have X number of dollars left over, they don't care what your actual expense ratio is.
Right. So the other thing is, like, if you had a short sale foreclosure.
Short sale is 12 months, foreclosure is 12 months as opposed to 2 years, and 3 years and 3 years.
They definitely take care of our veterans with that loan.
They do.
And your dad's a veteran,
yep.
so.
And it's a great loan, and anybody that's a veteran should be using that loan.
What's our max in Nevada?
$1 million anywhere nationally now. VA no longer has a loan limit. It's now $1 million max.
Okay, great. It used to be county by county, like FHA.
It used to be county to county, and it used to be county to county, and it used to have a national limit as well. And then they had high balance states, but now that's all gone away. There's not even VA jumbo like there used to be. It's all up to $1 million.
Awesome. So explain how that works for spouses and military dependent people.
So the veteran has to be married to put a spouse on,
right,
or a domestic partner now. They can go on, kids cannot go on, other family members cannot go on. And if a veteran dies, the spouse actually gets their eligibility as long as they were married during the service.
Got it. But then they have to be married when the spouse dies.
Correct.
Okay, good. Just can't be like some lady like like my ex-wife of 3 wives ago, she's.
No, you actually literally have to have been married, and I believe it's why he was in the service, because then you become what they consider a widow of a veteran, and it's still community property state, so that you use that.
And what's the form you need? It's called the DD
214.
That is a requirement on every VA loan.
Every VA loan.
Got it. I know we don't do a lot of this, but this is one of my favorite loans. It's the USDA loan. We do have some rural properties in Nevada, but since we're all in Las Vegas, this is an urban market, and you probably haven't done many of these, but you do know what it is. Do you want to explain a little bit about USDA loans?
USDA loan's a great loan if you can use it. It's mostly you can use it in Paradise and a couple of the other places here in Clark County, but
Mesquite.
But even in Las Vegas, there's a couple of places that allow you to have where you can use it. So the loan actually allows you to go to 105% of the purchase price, nothing down, and put in all your closing costs. It's a great loan, especially if you're in the rural areas, and you do a lot of stuff in the South, and that's a loan that's prevalent there.
prevalent. Yeah, like most of my deals are USDA. They're going zero down. They got zero skin in the game. Perfect if you're an investor. I always tell people, if you're investing in real estate,
the one thing about USDA though is that they do run out of money.
well, so hopefully they don't run out of money.
No, every year there's an allotment for it. So normally you don't have trouble getting it, but that's the one thing. Unlike FHA, the USDA is actually funding that loan. Where on an FHA loan, the lender funds it, and then HUD, Urban Development, buys the loan or insures the loan, and it's serviced by somebody. USDA loan is actually funding those loans out.
Great. And same thing with like FHA. FHA, you have lifetime mortgage insurance. Now that law was passed several years ago.
Yep.
So you're paying an insurance policy all the way
through until you refi it.
And let's explain what that is, just so you guys know, because this was totally confusing to me at the beginning. You're paying for your potential default. You're paying for your lender's insurance.
Well, FHA you pay twice. So you actually have the mortgage insurance premium, which is 1.75% on top, and then you have 0.85 if you put minimum down, 0.8 if you put 5% down. And then on the USDA, you're going to have the same calculations, but they're going to be for the life of the loan. You know, on a conventional loan, by law, once you get to 78% loan to value, the mortgage insurance goes away.
Hey, my guys put this on the sheet. I don't even know what this is. A HUD loan.
A HUD loan is basically an FHA loan, but on a HUD repo. So FHA is the Fair Housing Authority, but literally they're backed by HUD.
Right.
So when an FHA loan goes bad, it becomes a HUD repo, Housing and Urban Development repo. Those are loans that you can get, which is still an FHA loan, but investors are allowed to get them. They're $100 down to take over that property.
Sweet, great. So do you do many of those?
We do probably 4 to 5 a year.
Yeah, it's not
a big market here. It's big where FHA loans are a lot more popular in lower income demographics, and where we have a lot more people that are populated with the lower end, and when I said lower end, I'm talking $80,000, $50,000 loans, as opposed to in Las Vegas, our average price is $300,000.
One thing to mention, like know your market, know your market. We always talk about all markets are different. Like in Vegas, 10 years ago, we were probably primarily FHA, correct?
We were about 40% back then.
And now we're at 8%, you said.
8% of the loans are FHA.
And why is that?
It's because the Fannie Mae and Freddie Mac's, the 3% down product, the adjustments on those loans are a lot less than a normal buyer getting an a conventional loan. So, and the mortgage insurance is also reduced to help people get into properties. So it's been competing with FHA and winning. Like you said, the mortgage insurance drops after a certain percentage. The mortgage insurance normally, with a good FICO score on a 3% down conventional loan, is gonna be like 0.41. On an FHA loan, it's gonna be 0.85. So you're saving almost a half a point in interest right there. Plus the difference in rate is only about an 8. So your net savings is probably somewhere in the neighborhood of 0.75 going conventional.
Right. So most of the people we're talking to are learning how to invest into real estate. We talked about conventional loan being the way to do that. But when you don't have credit, but you found a great deal and you've got lots of equity in the deal, can you find me a lender? If I got bad credit.
Yeah, so that was the last thing I was going to tell you that we need to talk about is there are lenders now that go down to a 550 credit score. They're called non-QM lenders, and they're called DCS loans, debt service credit. So as long as the property will debt service itself, they'll lend you up to 75% of that deal.
So debt service is a fancy word of saying their rent or their whatever will pay for that mortgage.
Correct.
And everything else involved with it, the taxes, the insurance,
Correct.
all of that stuff. It's called a debt service coverage ratio, right?
Yep.
Okay, so here's what I want to point out. So I hope you guys enjoyed the video. Make sure if you did, you hit the like button. If you want any other questions that William can break down for you, comment below. If you want to get more videos like that, make sure you hit the notification button, because we're bringing you new videos every week. And the reason I want to talk about a little bit more about what William brings to the table here is because William is a problem solver. So we talked about his knowledge of loans. That's very clear. I mean, he's losing me, and I'm very experienced. So it's very clear that it's very important that he's an expert and that you surround yourself with guys who know how to get deals done. How I met William was I was selling foreclosure properties. One of the deals that fell out, somebody had told me, call this guy. He gets stuff done. So I called him. He's walking the sand in Palm Beach. I think you were like
Outside my house, yeah.
Yeah, he lived in Palm Beach at the time, moved back to Vegas, and he's like talking to me like nothing, because this is what he's been doing for years and years and years. There's never been a loan there's never been a deal I've given to him that he hasn't either said, yes, I can close this, that he's actually closed it, or no, don't waste your time. And then somebody else would have tried to do that and they just end up wasting their time and not getting the deal done. So let's talk about what makes a good lender. I believe it's a solution person versus a problem person.
So I feel it's three things. Number one, I'm a big Brian Tracy guy. I was trained kind of in that motivational field. One of the big things I learned is spend 30 minutes a day learning your business. You spend hours every day, sometimes till 2 o'clock in the morning, learning new stuff, right?
Yep, that's true.
You'll go research properties in Mississippi when nobody else will touch Mississippi after a hurricane. So number one, people that take pride in any kind of work, you talk about a doctor goes back every year, gets recertified, surgeons go back and they go back into CE training. Well, CE training is great, but at the end of the day, learning every day in your industry is the number one thing, because then you know what's current, you know what the issues are.
Right.
The second thing is reading guidelines and really finding solutions, like you said. Most lenders have no idea. Everybody wants to make heart surgeon money, right? Everybody wants to make Trey Kearns money, but nobody wants to spend the time to actually get educated and figure that out. So educating yourself is really knowing the guidelines, understanding what can be done, what can't be done. That's number two. So and I know they sound kind of similar. The first one is, most people don't understand that loans are really mortgage-backed securities that are probably in your 401k,
right?
Or your IRA. They're bonds.
Right.
You don't realize that we're just bond salesmen, right?
Right.
So they don't. That's what I'm saying.
So you're saying that mortgages are attached to the bond market?
Yeah. Not. Who talk about the Fed dropped the rates? So that has nothing to do with mortgages. They think it does, but it doesn't, right? So at the end of the day, it's understanding how loans work, understanding what risk really is, learning that piece of the business, then understanding the underwriting guidelines. Number two, and then three is just attitude. Figuring out that, okay, this person, I'll give you a classic example, kind of a story real quick. I had a guy, his son was hooked on drugs, ended up dying, overdosed, but had stole the guy's 401k, stole the guy's identity, and this guy never had missed a payment in his life. Tried to keep his kid alive for 3 years. Bring this guy in, and he's like, I'm moving here. He was gonna be working for a big furniture company. He was running 2 stores here. They brought him in. Nobody else would touch him. I looked at him and I said, so I got a 25-year good credit history. This guy gives me all the documentation about his kid. We get the guy an FHA loan, which nobody else would do. Why? Because an underwriter understood this guy had almost a medical issue with his kid. That wasn't his issue. The guy didn't go out and run a bunch of credit cards or go and buy, a $100,000 card and pay for it. This guy literally has identity stolen. We documented it all. A lot of work. But that guy deserved to get a loan. He's had 3 loans in the past, never missed a payment.
Right. So it's explaining the situation with documentation.
With the attitude of saying, I'm going to help that person, and really understanding how to help them and whether it's worth your help, All
right. Before we go, what's the name of your company? How can people get a hold of you if they are looking for a loan? And what states are you licensed in? I'm
licensed in Florida, Colorado, Arizona, Nevada, and California. Flora Mortgage. And our number is 990-0959, area code 702.
Let's say it one more time.
Flora Mortgage, 702-990-0959, and Florida, Colorado, Nevada, Arizona, and Utah.
And how many loans have you done, just so they can be comfortable that you know what you're talking about?
About 13,000.
13,000 loans, okay? 13,000 loans. You were running with Nevada back in the last boom, right?
I got licensed. I wasn't licensed back in those days. You just had to take a test. But literally, this is my 31st year, and there was 10 or 12 years where I was in the top 15 people in the country in production.
Great. And some of those people now are running some of the biggest companies in town, like Nick Flores, right?
Yeah, so Nick owns the 3rd largest mortgage company, and we worked together for years. I mean, yeah, he's a real deal. You're the real deal. He's the real deal. He's the real deal, yeah.
So we only bring people on this show who are going to explain things to you so that you can learn from it. If I don't know it, I don't know everything about mortgages. I know how to qualify for financing. I know you need to have good credit. I know you can't be a deadbeat, right? You got to make sure you don't be applying for every card and max it out. Have a decent credit score, but work with a guy who's going to look to solve and get you a loan. Don't work with somebody who's going to say, yeah, man, you just can't get it, right?
Yeah, when somebody talks to a lender, they're going to know if the lender really understands if they just ask them a few simple questions. Number one, how many loans can I get? What is your down payment requirements? And how long is it going to take you to get me done? And if somebody basically says, oh, you got to put down 25% and it's going to take us 2 months to get done, you're not really dealing with somebody that is really looking for you, because really you can get a 15% down A paper loan all day long, up to 20 of them.
And that transitions into my last and final, the juiciest point that I was going to tell you about, which is why you should never, ever, ever, never, ever, never, ever get a loan through a big bank like Wells Fargo, like Chase, like Bank of America, any financial institution, because they are not held to the same standard that he just explained. They don't have to go to continuing education. They don't even have to pass a test to get a license. You want to explain exactly how that works?
Yeah, so there's a thing called the NMLS that you actually have to get a license with when you don't work for a federally chartered bank. A federally chartered bank, you just have to basically get an MLS number. That's all.
So you have to have a heartbeat and a name.
A heartbeat and a name and a social. And then they give you this thing. You go into a bank and you're going to see a guy sitting there. He takes X number of applications from bank customers every week.
Right.
And he throws them into a corporate processor. And the corporate processors, they don't really even have a person he deals with. He deals with a corporate processing center. So your loan goes in, you get contacted by a third party that all of a sudden has no knowledge of your loan, has no mortgage experience. They're just doing paper. And this guy takes 40 applications and he closes 20 of them. The other 20 just go by the way, and he's like, not really our problem. The banks don't care. They're not. So in my industry, we're basically hunter-gatherers. We've got to go out and get business, keep realtors happy like you are, try to make sure that their business gets closed on time, everybody gets paid, or we don't eat. We basically don't get paid. On a bank, they get a salary and they get very little money on the transaction. Your transaction doesn't close with the bank officer, they don't care. Because again, they've got 20 others that the bank's feeding them.
Right.
If I don't go out and learn my industry and be able to service you as a customer, I don't get paid, my family to eat.
So are you saying, and I know you didn't say this, but are you saying that because of Dodd-Frank, that the banks put themselves in a position to pretty much control the market and wipe out the individual loan guy, making it?
They have, but it's just like internet lending. Internet lending is another piece of that same scenario. They hire people that don't know what they're doing. So if you have a 780 credit score and you're putting down 20%, you will get a better rate than anybody on the planet can offer you at a bank or on the internet. But if you really want good customer service and you want somebody that's going to actually build a relationship with you and take care of your financing needs long term, you can't go to those institutions because that doesn't work. And if you have anything that's out of ordinary, you have a car expense, for example, that goes on your tax return, though you'll automatically get kicked out of that stuff. It doesn't, they just don't have the ability to service you.
And to drive that point home and really employ on that, as a guy who sells houses, a guy who lists houses, when I see a Bank of America pre-qual, when I see a Wells Fargo pre-qual, I'm very apprehensive because I know it hasn't been vetted properly. If I see a lender pre-qual with Williams' name on it, I already know it's solid, it's closing, I don't have anything to worry about, and that is a good way to close deals.
Let's go back 10 years.
Right.
So if you will remember, I don't know if you guys know, Trey used to do hundreds of real estate transactions a year, but he would get these offers in with the Bank of America approval. And back in those days, Fannie Mae and that would say, we cannot direct the loan, but if your loan document's not entitled on this date, we can then move the loan. Well, that day would always come and I'd have 10 days to scramble because Bank of America could never deliver because again, they don't care. It's just, you're just a number. Where we would scramble the last 15 days of the month and say, okay, now we gotta get all these deals done,
right. So yeah, you can close a loan super fast. We've established that. He's a super smart guy. Thank you guys for tuning in. I hope you got a lot of information here today. I think you understand that I'm bringing real guys, real content to you every week. So make sure you do me a favor, subscribe, hit the like button, and comment, share it with a friend. Do whatever you do. We'll talk to you later.